Ever wanted to own a slice of Apple, Infosys, or that meme stock your cousin won't shut up about? Today, I'll show you exactly how to buy stocks online and build a beginner-friendly portfolio, all in classic stick figure style. Welcome back to Stick Finance 101, the doodle dojo where investing finally clicks. Grab your pens, pizzas, and portfolios, and let's dive in. First things first. To buy stocks, you'll need a Demat account. Think of it like a digital locker, but instead of storing gym socks, you're storing shares. You can't keep stocks in your cupboard unless you want angry calls from stock exchange. Pick a stock exchange registered broker carefully. Look for zero commissions, a smooth app, solid reviews, and zero history of leaking your personal ID details in sketchy WhatsApp groups. Complete your KYC with a quick selfie and an e-signature, and boom, your digital locker is ready. Once your Demat is open, you're ready to order your first share. But how exactly do you do that? Imagine ordering pizza. You can shout, "Hey, give me whatever you have ready now." That's a market order. You'll get the quickest available deal, but you might pay more if the pizza guy knows you're starving. Or you could politely say, "I'd like a margarita, but I won't pay more than 250 rupees." That's a limit order. You set the maximum price you'll pay, protecting you from surprise charges and nasty toppings. For your first purchase, a limit order is your friend. You won't wake up the next morning with buyer's regret, like discovering pineapple on your pizza. Now let's talk about how to actually build your portfolio. Buying one single stock is exciting, but risky, like betting your entire allowance on one cricket ball. Great if you win, painful if you lose. The safer, smarter move is diversification, spreading your investments across several stocks and assets to protect your portfolio from crashes. Think of diversification like a cricket team. Blue chip stocks are your Sachin Tendulkars, reliable, steady performers who score consistently. Mid-cap stocks are the Shubman Gills, young players with lots of potentials to grow, but some risks involved. Bonds are like warm, homemade cookies, stable, comforting, and predictable. They won't give you adrenaline rushes, but they keep your investments safe. A classic beginner-friendly split is called the 60-30-10 rule. 60% stocks, 30% bonds, and 10% cash. This gives you the excitement of growth with the stability of safety nets. It's like training wheels for your portfolio, but you can't set and forget forever. Once a year, rebalance your portfolio. Sell the bits that have ballooned too big and invest in the assets that got left behind. It's like trimming a bonsai tree. Small, careful cuts keep your investments healthy and balanced. But beware the traps every beginner faces. Trap 1. Meme stock FOMO. Buying stocks just because everyone on social media says they're about to go to the moon. Usually, these rockets crash back to Earth faster than you can say losses. Trap 2. Overtrading. Trading too frequently can rack up hidden fees and taxes, nibbling away at your profits like tiny hungry piranhas. Trap 3. Forgetting taxes. Remember, the taxman always wants his share. Track your gains and losses clearly, or you'll have a surprise waiting at tax season, and not the fun birthday kind. Now let's do a quick recap. Open a Demat account, secure and digital. Use a limit order for your first stock. Control your price. Diversify your portfolio. Balance stocks, bonds, and cash like a cricket team. Rebalance annually. Trim the overgrown and feed the underdogs. Avoid rookie traps. Memes are funny, but losing money isn't. If you enjoyed this video and learned something valuable, smash that subscribe button to join our doodle-powered investing family. Turn on notifications so you never miss another finance-friendly video from Stick Finance 101. Thanks for watching. I'm your Stickman, and this is Stick Finance 101, and your money journey just leveled up. See you next time, same stick channel.